My name is Chuck Whitman, and I build great traders that lead great lives. Traders I've trained have generated in excess of $1 billion in trading revenue and are found at some of the largest proprietary trading firms and hedge funds in the United States. 21 trading tips from Paul Tudor Jones, part 3. Today we're going to cover tips 11 through 15. Tip number 11, don't be a hero, don't have an ego. One of my favorite quotes is this quote: markets can remain irrational longer than you can remain solvent. That's from John Maynard Keynes. Everybody knows John Maynard Keynes is a famous economist, but what most people don't know is that he was also a very good trader. We don't want to have an ego when we trade. We don't want to try and impose our will upon the market. We don't want to come to the market with an agenda that's different than making money. Remember, when you come to trade, you should have one objective, and that is to make money. And how do you make money? By following your rules and following your plan. That's why you're there. No other reason. Now, to prove how smart you are, when we come into the market, if we're not clear about who's in charge, there could be a part of you that's actually doing the trading. And that part of you may have an agenda that's different than making money. One thing that was very useful for me was Dr. Van Tharp. When I was working with him in his super trader program, he had this theory called parts theory. As we go through our lives, there's these different parts of us that emerge from ourselves as we go through life. And those parts stay with us throughout our entire life. So there might be a part of you that's a 5-year-old kid. Might be a part of you that's a 16-year-old high school student. The ego shows up. It starts to show up in our lives when we have some kind of pain or some kind of trauma. What happens is somebody does something to us when we're a kid, and what we do is we don't like this pain. When we experience the trauma, we create this part that experienced the trauma. That part is splintered off to the side. This allows us to get the pain out of the way and allows us to go on with our life. But the problem is if this part of you is never addressed, it can slide back in front. So the overall belief is there's you, what we call, I worked with Dr. Libby Adams, and she called it the big I. The big I represents your soul. This is who you truly are. And then there are all these little I's, which are these parts that have splintered off. Well, you want to be really clear who is in charge. Is it you and your big I, your authentic self? Or is it one of these little I's that has hijacked your brain and is running some kind of short-term agenda to not feel pain, to get some kind of pleasure? When I started to study this, I realized that there were two parts of me. There was my young adult, and there was actually my dad. And those parts of me had agendas very different than actually making money trading. They were about significance. So at the time, I was trading on an exchange floor where everybody could see me. And on the floor, everybody looked up to traders that traded big size. It was like an assumption that if you were a big trader, if you traded big size, you must be really good. You must make a lot of money. And what I came to learn is that was not the case. Some really did make a lot of money, and some were just wild gamblers, and it was a matter of time until they blew out. So I would make a lot of big trades. And when I'd make these big trades, everybody would look at me like, whoa, did you see that trade that Chuck made? He just sold 500 of those calls. Well, when I'd make that trade, my ego would boost. I'd be like, yes, this is Chuck, the big trader. But the problem was they weren't good trades. The problem was they put me into bad positions. The problem was they caused me enormous amounts of stress. The problem was I missed opportunity after opportunity because I was bogged down in these shitty positions. I couldn't let them go. So it's interesting when I worked with Dr. Tharp and I started to recognize that this part of me was actually hijacking it, I went and made a deal with it. I said, tell you what, I'll make you a deal. You stay out of my trading, and I'll get you all kinds of significance outside of trading. You stay out of my trading, we'll go get a super cool car. We'll go buy the best of clothes. We'll go night clubbing, and we'll go get VIP tables and go all out. We'll go on vacations to Miami or New York or wherever. Just stay out of my trading. And you know what happened when I negotiated that with that part? My P&Ls exploded. And all these things that I promised were easy to pay for because I was making so much money trading. We must keep our ego out of the market. When our ego is in the market, we cannot see the market for what it really is. For you to succeed as a trader, you have to be able to see the market for what it is. No attachments, no agenda. Tip 12, I consider myself to be a premier market opportunist. Warren Buffett is famous for saying, be fearful when others are greedy and be greedy only when others are fearful. This is essentially what Paul is talking about. Paul is a premier market opportunist. He waits for things to line up. He waits until people are panicking or people are scared, people are fearful. They're dumping positions. They're afraid to buy. One of Paul's biggest edges is his psychology. I've heard him say this to me. I've heard him say this in interviews. He says that one of his greatest edges is that he can sit in pain, unlike few other people. He can sit in pain and not be fazed. He can step up and execute. He's trained himself just like special forces, that he can step up and execute with precision in the midst of pain in a way that an average trader could not even begin to handle. So when a market starts to go into a panic, Paul uses these periods of fear to take advantage and to be able to enter large positions at fantastic prices. Conversely, when the markets get exuberant, when they go parabolic, Paul uses that to be able to liquidate into these extremes and sell the high. This is a big belief that I have. One of the things that we both have in common is we both believe in trend following. I believe in trend following, but we also both believe in trading at the extremes. And that means if I'm long a trend and it goes parabolic and it gets overbought, I'm going to liquidate into that trend. And it means if a market sells off, I'm going to be sniffing around. If it gets into volatility extremes on the downside, it gets too stretched, I'll be going to be sniffing around looking for places to start to buy, which is going to come to one of the next tips. I believe the best money is made at market turns. Well, what I just described, when I said the market is at a volatility extreme on the downside, there's panic selling, and I'm in sniffing around. What I'm looking for is the first sign that there might be a little bit of a market turn. Because if I can enter on that turn, the thing about market turns is they give you phenomenal risk points that you can really lean on with high confidence to know that they should not break. And if they do, that is a big, big sign that the market is in trouble, or it's a big, big sign that your idea is wrong. So when you talk to great traders, we all know that being wrong is just part of the game. We're all totally fine with that. What we love is when we know for sure that we're going to be wrong. If I put on a trade and I have a risk point and I know if that point gets hit, I know I'm wrong. I love that because that gives me conviction, one, to put the trade on, but two, when it hits that level, I'm out and I may even be going the other way. So these market turns provide these amazing risk points that you can lean on, have really good reliability, and create phenomenal reward to risk ratios. And the thing about this is if you catch these turns, they tend to pay off very quickly. You'll tend to have 3R, 4R, 5R in hand before you even blink. And this is why you can make an enormous amount of money or lock in an enormous amount of money in a short period of time. 14, everything gets destroyed 100 times faster than it's built up. This is just an example from 2017 and 2018. This is the VIX shock. See here that the Dow Jones, it broke out on November 17th and it rallied straight up for 2.5 months. This was a very strong rally. In fact, it's really the only rally I've seen in equities that actually hit a volatility extreme on the upside. They always hit them on the downside. You never see them hit them on the upside. This one actually did. Look, it took back 2.5 months in 1 week. Went all the way back to where the whole move started. This is what we're talking about. You can have a year-long trend that could literally be wiped out in a week. You can look what happened in China this week. China had been in a prolonged downtrend, months and months and months of being in a downtrend. And then they announced a stimulus package, and you literally erased a year or more of downward trend in a week. So why is this important? It's important because if we know that this phenomenon exists, then we can diligently understand and manage our risk. One of the things we talk about all the time, I teach my traders to trade from a position of strength. And what does that mean? That means that they're never put in a situation where they have to be in a hurry. They're never in a situation where they have to panic. They can take their time and make the right decision. How do we do that? Well, one of the things that people do is they have a stop. If the market breaks hard and hits the stop, it's going to create some panic. It's going to create some volatility if that's a level that has a bunch of stops. And that opens up the door for you to get knocked out, get a really bad fill with a lot of slippage, and then watch the market V out and go right back up without you. So what do? I'm really big on options. And one of the things that we're doing is we're always looking at our stop levels. And instead of having a stop, we replace it with an option or some kind of option structure. In one of these situations where a market goes up for a year and then goes down in a week, well, we're always going to be hedging such that if it starts to break, we're going to have these little options on that when the market goes against us, these little options that we have as a hedge will explode in price and they'll bail us out. They'll cover our ass. That's why it's important to understand this. Finally, markets move sharply when they move. Duh. Well, not always, but what does he mean here? Really what Paul is referring to is this idea of the volatility cycle. And the market goes through periods of volatility contraction and then volatility expansion. And volatility expansion leads to contraction, which leads back to volatility expansion. It's being aware of what the volatility environment is. And if we have a market that has gone into a volatility contraction and then it begins to move out of that range, we need to be thinking that this market could move sharply in that direction. A lot of traders, when they see the market starts to pop out of a range, they want to fade it. We don't want to fade it. If this move, especially if it's confirmed by volume, we want to be going with it. We want to understand the volatility cycles that exist in the market, and we're going to use them for how we manage our positions. This can make a massive difference in how you profitably trade the market. So I'm going to show you an example. This is NVIDIA. So you can see last year with NVIDIA, you can see that this green here represents what we call a volatility squeeze. This is where the range has got really tight. We're actually in another one right now, but it's a big squeeze. So last fall, we were in a squeeze, and then you can see when we broke out of it, that's when NVIDIA exploded. We broke out of it. NVIDIA basically went up 180%. 180% out of this tight volatility range. So we don't want to fade this. So understanding the volatility cycle and understanding that when volatility starts to expand, you could get a big move fast. You need to be aware of that. With these tips today, hopefully you picked up some very useful information. There's a handful of things I said in here you will not see talked about anywhere else. Like what I mentioned to you about stops. We do things at a whole nother level. I've been trading on a whole nother level for 30 years, a very long time. There's very little in this game that I've either not done or I have not seen. And I'm sharing it with you bit by bit, week by week. Because after all, what day is it? That's right. It's Tuesday. And we know it's not any Tuesday. It's Trader Tip Tuesday. Now, on Trader Tip Tuesday, I come to you with information and tips like today that help you take your performance to an elite level. So I will see you next Tuesday.